Good morning. We will pay attention to the weighted average method today, and we will show how it will be differently done when the perpetual and the periodic inventory system is used. If you understand the difference between perpetual and periodic, you will realize that in the perpetual inventory system, every time an article is sold, the cost of sales is determined and the effect on the inventory available is recorded. In the periodic system, you don't calculate the cost of sales every time when something is purchased or sold, and when goods are sold. Therefore, in the periodic system, you will never record something in the inventory account during the year, and you will not determine how much stock is available during the year. It is only done with a physical inventory count. The following information was obtained from Harvey Stores for the year ended 31st of March 2015. They used the weighted average method. Now, when the weighted average method is used, it means that they don't sell the first stock first. They just put all the stock together when it's purchased, and they calculate an average price between the old stock and the new stock. So if we look at this information, at the beginning of the year, we had opening stock of 20 units at 10 Rand each, so the value was 80 Rand. They also tell us that goods were purchased on the 9th of January, 20 units at 4 Rand 50. And there was 15 units purchased at 6 Rand 50 and 12 units at 7 Rand. So if we want to calculate the inventory on hand at the end of the year, we will start with the opening inventory of 20 units at 4 Rand each, 80 Rand. Then we bought 20 units at 4 Rand 50. And if you read in the additional information, you will see that they started buying stock from a new supplier, and that this new supplier charged 50 cents carriage on each product. So in the opening inventory, there's no carriage because the goods were purchased in the previous years. In the current financial year, you have to add 50 cents to every product, and the accountant did not include this carriage on purchases when he did the calculations. So when we determine what is the cost price of the goods purchased, we will add the 50 cents every time to the cost price, multiplied with the number of units, and that will tell us what is the value of all the units. And we will write down every time how many units that we buy, so that we can determine the total number of units available. That will include the opening inventory plus all the units purchased during the year. Then we will add up all the money, and we say that 67 units cost us in total 375 Rand. So if I want to calculate the average price, I take the 375 divided by the number of units, and that tells me that the price per unit is 5 Rand 60. So because we are using the periodic inventory system in this calculation, and they don't calculate cost of sales every time when something is sold, and they don't show the effect on inventory every time something is purchased or sold, we can, in the periodic system, just add all the units together because the calculations is only done at the end of the year. If we want to determine our closing inventory, then it means that we will look at our opening inventory, and we will see that we had 20 units at the beginning of the year. The numbers that we purchased was the 12, 15, 12. So it means we bought 20, 15, 12, 47 units. Then if we go and we look at the total number of units that was sold, we sold 20 units, and then we sold 25 units. So therefore we sold a total of 45 units. And if I subtract the 45 from the 67, it means that in my closing stock, I have 22 units left over. If I want to know what is the value of that 22 units, I will multiply it with the average price of R5.60, and the average price will then be R123.20. So my closing stock is valued at R123.20, and the total number of units that we have available at the end of the year is 22. If we want to calculate the cost of sales, it means that we have to determine how many units were sold, and we sold 45 units. They've given it to us. The cost price is the average price of R5.60, so it means that the cost of sales will be equal to R252. If we want to calculate the gross profit, we have to determine the sales price and the cost of sales to calculate the gross profit. Now, in this example, with the sales, they give us additional information. So first of all, remember that we sold 20 units and then we sold 25 units. And they say 20% of the units during the year were sold for cash. That means 80% was sold on credit. And if people buy cash, the entity allows 10% on all goods that were sold for cash. So we will only receive 90% of the total price. So remember, 20% was sold for cash and 80% was sold on credit. When there's cash sales, we allow 10% discount, and the sales price is R15 per unit. So if we want to determine the sales, then we look at the number of units. We sold 45 units. 20% of those units are for cash. That means that we sold 9 units for cash. Because they pay cash, they get 10% discount, so they will only pay 90% of the normal sales price. So if I multiply the 9 with the 90% of 15, I get R121.50. The credit unit is 45 units that were sold. 80% is sold on credit. They don't get cash discount, so we multiply with 15, and my total sales for credit sales is then 540. If I add these two figures together, it gives me my total sales as R661.50. Okay, if we want to calculate the cost of sales, then we look at the opening inventory, and there we saw the opening inventory was R80. Then we go and we look at the total purchases. So I will add the 100, 105 and 9 together, and that will give me 295. And then I must subtract the closing inventory because we are using the periodic inventory system, and we calculated that the value of the closing inventory is R123.20. So I will show the R123.20 there as closing inventory. Cost of sales therefore will be the 80 opening inventory plus the 295 minus the R123.20, so cost of sales will be R251.80. If I subtract the cost of sales from the total sales, I will get my gross profit as R409.70. So in this part of the example, we did the periodic inventory system. Therefore, we don't calculate the cost of sales every time something was sold, and we don't record anything in our inventory account during the year. And because we don't have to do that, we can just do the calculation and see what is the total inventory on hand, what is the average price, what is the cost of sales by doing a short calculation. We will use the same information that we used for the periodic system but now we will pay attention to the perpetual inventory system. When we use the perpetual inventory system, cost of sales and closing inventory must be determined after each transaction. That means that you have to determine every time when you buy something what is the new average price, because you have to determine what is the effect on inventory all the time in the perpetual system. Every time when something is sold, you must determine how many units are left over and what is the value of your closing inventory. So if we look at this example here, we will start with a balance of 20 units. We paid 4 Rand per unit, so that means it gives me 80 Rand. Okay, then we go and we buy on the 9th of January 20 units at 5 Rand each. That will give me 100 Rand. Now, because it's weighted average, it means that we don't keep the units that we buy separately. We put all of them together and we work out an average price every time. So I will take this 20 units that we had at the beginning of the year, and I will add the 20 that we bought, and I will say now we've got 40 units. Then I take the 80 Rand at the beginning of the year, I add the 100 Rand of the purchases, and I will indicate that the total cost of the 40 units is therefore 180 Rand. To calculate the average price, I will take the 180 Rand divided by the 40. So the 180 Rand divided by the number of units 40, and that will give me an average price of 4 Rand 50. On the 22nd of January, we sold 20 units. Now remember, everything that we calculate in this table is at cost price, so don't use the sales price here. When we get to the income statement, we will determine the sales price. So you have to take this 4 Rand 50 average price that you calculated and say that this 20 units will be sold at the normal sales price, but the cost price of those units were 4 Rand 50. So what was the cost price of all 20 that we sold? And I will take the 20 times 450, and that will give me 90 Rand. Now I have to calculate my weighted average again. When we sell goods, we don't change the weighted average. We only change the weighted average when we buy goods or we return goods to creditors. Here we had 40 units. We sold 20 units, so that means we've got 20 units left over. We had 180 Rand. We've sold goods with a cost price of 90, so that means the total value of the goods that's left over is 90 Rand. So 20 units is left over after we sold 20. 180 minus 90 gives me a cost price of 90, and I don't work out a new cost per unit. Then on the 4th of February, we buy 15 units for 105 Rand. Now, when we buy, we have to work out the weighted average price again. So I will take this 20 units that I had plus the 15 units that I bought, and I say now I've got 35 units. The cost of the 20 units was 90 Rand plus the 105 Rand that I paid now will give me 195 Rand. To work out the average price, I take the 195, divide by 35, and that gives me 5 Rand 57. On the 1st of March, we buy again 12 units at 7 Rand 50. So the 35 units that I had there, plus the 12 units that I bought, means that I've got a total of 47 units now. The cost price of the 35 units was 135 Rand, plus the 90 Rand that we paid now will give me 285. So to calculate the average price, I will take the 285 divided by the 47, and then my new average price will be 6 Rand and 6 cents. On the 27th of March, we sold 25 units. So of that 47 that we had, we sold 25, so we've got 22 units left over. The average price is R6.06, so it means that the cost price of the 25 units that we sell is R6.06 each. 25 times R6.06 will give me R151.50. We had R285 minus the R151.50, so that means that value is R133.50. I don't calculate a new cost price when I sell goods, so the average price remains R6.06. If we want to calculate the gross profit, we will do exactly the same calculation for the sales price. So it's 45 units, of which 20% was sold for cash, and on the cash units, we will give 10% discount, so they will only pay 90% of the normal R15 sales price. Credit sales of the 45 units, 80% were sold on credit. There's no discount, so they pay R15, and that will give me the 540. Then for cost of sales, I will go and look in this table, what did I calculate for cost of sales, and I will put that in there as R241.50. And if I subtract the cost of sales from the sales figure, I will determine the gross profit. Now, if you look at the previous example where we did it according to the periodic inventory system, exactly the same information, and we do it according to the perpetual system, you will see that the gross profit is not the same as it is in the periodic system, because in the periodic system you don't work out a weighted average price every time when a transaction takes place. We only do it at the end of the year. In the perpetual system, we will work out a weighted average price every time, and that's why they don't give us the same results. So what did we learn today? When the weighted average method is used, the value of closing inventory and cost of sales will not be the same when you use the perpetual and the periodic inventory system. The perpetual inventory system, after each purchases or when you return goods to the creditors, the value of the inventory is determined to determine how many goods do you have left over and what is the value of those goods, and a new average price is determined. In the periodic inventory system, the value of closing inventory is only determined at the end of the year. So you won't do a calculation every time to determine how much inventory is left over. And at the end of the year, you will take the number of units available multiplied with the average price, and that will give us the total value of your inventory at the end of the year. In the perpetual system, every time something is sold, the cost of sales figure is determined when goods are sold or returned. In the periodic system, we don't use a cost of sales account, so the cost of sales will only be determined at the end of the year using the number of units available at the end of the year multiplied with the average price. When goods are sold, the average price is not affected in both methods. So when you sell goods, you don't work out a new average price. The sales price will not have any effect on the calculations to determine the weighted average price. So don't use the sales price when you do calculations in both methods, because the sales price will be used when you do the income statement.